This meeting is being recorded.
Good afternoon, everyone. Thank you for registering and attending today's webinar, and I hope you have a healthy and joyful 2022. We're just going to wait for the participants to dial in now. We're seeing the numbers coming in, and I'll just give maybe a 1 to 2 minutes while participants are joining. So please bear with us, but we will start in 1 minute to 2 minutes. Thank you. Good afternoon, everyone. I think we'll make a start now while the others are still joining. First of all, thank you again for registering and attending today's webinar. And thank you to Malaysian Chamber of Commerce for organizing this event and inviting Ernst & Young to present on the topic of Malaysia's new foreign source income rules and an overview of the economic and fiscal landscape. So my name is Joanne Yi. I'm an International Tax and Transaction Services Partner with EY Hong Kong. And today with me are my esteemed colleagues, Mr. Amarjit Singh, who's tax leader and also an ITTS partner, alongside also his colleague from EY Malaysia, Ms. Sharon Yong, who's also an ITTS partner. And I'm very, very excited to hear what they have to say, as I'm sure many of you, on the new foreign source income rules, which obviously has been a heated topic, one of which many people are debating and discussing on. Clearly, the topic is still obviously in its, I would say, infancy stage, and is subject to changes and so on. But Amarjit and Sharon will, of course, update you as the latest, based on, as of today's understanding and observations. And I'm sure we're going to have a very insightful session. Just some background on Amarjit and Sharon is Amarjit has had 20 years of tax experience. She specializes in tax structuring, incentive planning, group reorganizations, and IPO. And he works very closely with key stakeholders, including regulatory bodies, tax authorities, industry associations, and government agencies on many key policy matters related to tax. So I think Amarjit's insights and obviously his dealings with many of the government officials from our perspective have more than 18 years of tax experience, and she advises on corporate and international tax advisories and M&A across a broad range of sectors. And now I think what we will do is start the discussion. So clearly, in the last couple of years, BEPS, which is base erosion, profit shifting, and also many international tax developments, such as this EU grey listing of Malaysia and also Hong Kong, incidentally, has led to many changes and discussions both in Hong Kong and Malaysia. Malaysia obviously has been placed in the EU grey list of uncooperative jurisdictions for tax purposes, and that is leading to tax law changes with respect to the foreign source income exemption. So today's session, I'm going to pass firstly to Amarjit to start the discussion today. And thank you, Amarjit, again for your time and your thoughts on the session. Thank you, Amarjit.
Thank you, Joanne, and thank you, Mei-Cham, for giving us this opportunity to be with your members. And hello, everyone. A very good evening, I would say. I think Hong Kong, Malaysia, same time. So just a very quick, the way I think we will do this between me and Sharon, I will perhaps just go through a little bit on the policy trend, and in terms of fiscal policy, and then I will invite Sharon to perhaps go through the details of the foreign source income exemption developments that are taking place in Malaysia. And I think more importantly, we would like to leave time at the end for Q&A. And you can actually start sort of texting your question into the chat box, and we will try to answer as much as we can. So let me begin first with what's really on the horizon, and this is something not specific to Malaysia. This is something that I think we see across the globe. Right at the outbreak of the crisis, the focus for many governments was really on relief to ease administration burden arising from the many different versions of lockdowns, and we saw things like deferment of tax payments, extension or concessions given in terms of filing deadlines, and as governments move to contain the pandemic and introduce mitigating measures, especially to save lives and livelihoods. We saw many different stimulus measures in terms of outright cash, and also some tax measures. For example, loss carry back, moving or extending the limitation of loss carrying forward, monetizing tax credits, and many more, right? So each government introduced measures that were specific to their jurisdictions, and similarly we saw extensive measures in Malaysia as well. Now, as market opening up borders and as stay-at-home orders loosen, the stimulus measures are now aimed at recovery, and measures mainly include investment incentives, sometime in 2021, and also late 2020. You would have heard about Malaysia introducing relocation incentives, tax incentives, and I would say very generous incentives, which actually we are already seeing some positive results coming out based on at least my conversation with some very senior officials of the Malaysian Investment Development Authority, the Malaysia Digital Economic Corporation. I hear you're going to be hearing some major announcement in terms of how well Malaysia did in terms of FDI investments coming into the country for 2021. I don't think the official announcement has yet been has been made by the minister yet, but we should be hearing that soon, and it'll be a very positive report. So some of these measures have really turned out in a positive way for Malaysia. Now, as we gear towards post-pandemic, and as we gear towards getting into a state of endemic, the policy responses are expected to ensure economic resilience and trying to manage debt, and therefore the focus is on revenue raising to pay down debt, and we see that across the globe. I witnessed that across ASEAN as well, and this include measures to increase tax and, in fact, consideration of new taxes. So I'll try to maybe go through some of the new taxes that we are seeing across the region as well. Rina, if you can move to the next slide, please. So Malaysia, if we just look at the some of the statistics, our debt to GDP has increased. It's really all-time high, sitting at 70.7% of the GDP. It's an increase of another 3.3% from 2020. So for FY20, we are looking at a fiscal deficit of 6.5. Okay, and this all points to the real need for us to really have some serious measures in terms of ensuring that we increase the tax revenue collection. Okay, next please. So what have we seen in Malaysia? Number one, of course, Malaysia is a signatory to the two-pillar proposal under the OECD BEPS 2.0. So this is about minimum tax, and whilst we've not yet officially heard of any specific measures on pillar 2, and actually on the ground, what we are seeing is agencies like MIDA are still pretty aggressive, pretty bullish. They are still going out there, trying to attract new investments and actually offering incentives. In fact, what I hear is, in some of these trade missions that the government actually goes, and where we have very senior ministers and where we have very senior MIDA officials in those trade missions, actually there are in principle approvals being given on incentives, right? But at the same time, I'm aware of work streams taking place at the Ministry of Finance, even with agencies like the Inland Revenue Board and MIDA, in terms of how and what should be the shape of incentives moving forward. So there is actually currently a study that is being undertaken on incentives. EY, what we've done also is we've brought some of our clients, global MNCs, global tax directors, to have a session with some of the agencies to also share their perspective of how they would look at especially the Pillar 2 proposal, so that there is enough viewpoints for the government to develop the incentives regime moving forward. So I personally expect the changes to be announced sometime this year. It's difficult to predict which time of the year in 2022, but surely sometime this year we should expect the announcement. All I will say is I think it's going to be a little bit more agile, and maybe the days of full exemption at 0% is going to go away. Okay, Malaysia has always been a very strong trade nation, and therefore each time any of the foreign bodies look to put Malaysia on a grey list or a black list, or any type of a watch list, Malaysia does react quite promptly. And as we saw with the EU watch list due on foreign source income exemption, it came out, I think Malaysia was on that list, and it was published sometime, I think, in October, or was it September last year? And very quickly in the national budget that was announced in end of October, we saw the FSIE being removed altogether, right? And subsequent to that, and of course, if you hear the minister's budget speech, one of the reasons that was said out there was not just that this is an announcement, or this is a measure to get us out of the EU watch list. It was also seen as a measure to raise tax revenue. Okay, but since then, there have been developments. The corporate world engaged with the Ministry of Finance, the accounting firms, including EY, working with the Chartered Tax Institute of Malaysia, also engaged with the Minister of Finance, and some changes have been made, something that Sharon will go through in detail. So just remember, the first measure at the budget announcement was a sort of a holistic, total blanket removal of foreign source income, and then subsequent to that, I think there are some concessions. So for companies, for limited liability partnership, the exemption is now on dividend income. Whereas the other income, the exemption has been is still removed. For individuals, it's all income. So Sharon will go through the details with all of you in a bit. Right now, I've mentioned that, there was, the big bang incentives that were announced over the 2021 and a later part of 2020 in the budget. We saw that theme being replicated. Now, the other bit that we see is also an increase or enhanced focus on tax audits. And we observe, and actually, in this space, actually there's no discrimination. You can be a locally held company, you can be a foreign-owned company, you can be a high net worth individual. All of them, what we saw was in all sectors of the economy, there was just simply enhanced enforcement activities in terms of tax audits, tax investigation. And it's not just a Malaysia phenomenon. We are seeing that in most, if not all, of the countries in ASEAN. Okay, so the next slide, please. Okay, so with that, I'm going to pass this on to Sharon to go through the details, and then I'll come back on at the end to address some of the questions that you may have. Thank you. Sharon?
Thanks, Amajit. Good afternoon, everyone. And also thank you to Mei Chan for organizing this session. Following Amajit's earlier overview on the economic and tax landscape, I will maybe discuss a bit more in terms of perhaps the most significant change to the Malaysian tax regime coming out of Malaysian Budget 2022, which was announced in October 2021. I think Amajit already alluded to this earlier, which is basically the removal of the foreign source income exemption, FSIE, which became effective 1st Jan 2022. Rina, can we have the next slide? Okay, thanks. So to give context, Malaysia generally adopts a territorial scope of taxation, where income tax is imposed on income derived or accrued in Malaysia, except for those which are in the business of banking, insurance, or sea or air transport. Foreign source income, which is received in Malaysia, is technically subject to tax in Malaysia. However, up to 2021, all FSI received in Malaysia by any person would have been specifically exempt from income tax under a specific law, which is paragraph 28, Schedule 6 of the Income Tax Act, with the same exceptions. Generally, since 1995, actually FSI received in Malaysia would not have been taxed, but maybe under different forms of legislation prior to 2004. So this change in 2022, effective 1st Jan, is a very, very big change. What we saw in the law is a wholesale removal, as mentioned by Amajit. Basically, it is to remove exemption of foreign source income for all Malaysian tax resident taxpayers. Okay, next slide, please. So just to go through a bit of detail in terms of the events that took place in the last, I would say, couple of months, in October to December. So Budget 2022 was announced on 29th October, and it was during that announcement that we saw this being introduced. Like I said earlier, all types of FSI would have been taxable in the hand of Malaysian tax residents. In that announcement and in the finance bill, we also saw that there will be a special rate of 3%, something like a concession period, to be applied on FSI received in Malaysia from 1st Jan 2022 to 30th June 2022. And any FSI received in Malaysia after 1st July 2022 will be taxed at the prevailing tax rate. And in Malaysia now, the headline rate will be 24% for corporates. Just to share also, in November, actually the Inland Revenue did announce a program called the Special Income Remittance Program. This was actually meant both to, I think, to encourage repatriation into Malaysia, as well as to allay fears of people who feel that they may be subject to audits and perhaps investigation when they bring in the income into Malaysia. So what was announced in the SIRP is that anyone who brings income from outside Malaysia back to Malaysia during this 6 months period, firstly, the tax rate will be lower at 3%. And secondly, the IRB commits to no tax audit or investigation on those income that is remitted back to Malaysia. But what we did see subsequently was this program seems to, the FAQ for this program seems to have been removed from the IRB's website. This could have something to do with the later announcement on 30th December. And we are still waiting for further details from the Inland Revenue on this. Since the budget announcement in October, end of October, up to 30th December, before the announcement was made, there has been various consultations and discussions, like Majid mentioned. I think in the media, you will see a lot of feedback and concern being raised. In terms of the scope of the removal, basically it's a wholesale removal, as well as the timing of implementation. It's almost immediate. So a lot of stakeholders and a lot of consultations with the MOF and the IRB were had. And following various rounds of discussion in this short period, ultimately, the MOF issued a statement on 30th December 2021 to say they will announce a 5-year conditional exemption on FSI effective 1st Jan, and that the IRB will issue guidelines on how the conditions would work and whether there are any further requirements on the exemption. What we did note in that short announcement from the MOF, they mentioned specifically the category of taxpayer. So for individuals, it appears that all types of income of foreign source income for individuals will still continue to be exempt, and only for companies and limited liability partnerships, LLP, would be exempt for dividend. Sorry. So any other income that is not dividend appears to be not covered. There's also questions about what about other types of taxpayers, other categories of taxpayers, like unit trust, for example. On the face of it, it does not appear to be covered. However, since we have not seen any further communication from the MOF or the IRB on this, we really need to wait for the details before we can see how would this work. Also to mention that the exemption period is from 1st January 2022 to 31st December 2026. So I think what we understand to share, actually during the consultations, there was no period discussed in terms of what exemptions being proposed or being requested for. But this may indicate that actually we will eventually move into the system where we will tax the foreign source income, and this is really to allow time for parties to work out what can be a more acceptable transition period for taxpayers. Next page, please. So where there is taxation in Malaysia where the exemption no longer applies, and the income has already been taxed in another country, you will have a situation of double taxation. And under the Malaysian income tax framework, there is an avenue to claim foreign tax credits against the Malaysian income tax that's charged. So where there is a double tax agreement, the law allows a claim of bilateral credits. Where there is no DTA, the law still allows for a unilateral credit to be claimed in respect of any foreign tax that's been paid. And we can go through a bit more detail in the later slides. General rules for claiming the FTCs is within 2 years after the end of the year of assessment. And basically, the credit should not exceed the Malaysian tax payable on that foreign income and the total tax payable on chargeable income for that particular year. and any unutilized credit cannot be carried forward. Next slide, please, Rina. For completeness, would highlight that there is a public ruling that really sets out in a lot of detail how bilateral and unilateral tax credits are claimed for purposes of Malaysian income tax. But the Inland Revenue has also stated on its website that this public ruling itself has not taken into account the FSIE change. So we think there should be an updated public ruling that would provide further guidance that will show examples where addressing the FSIE removal. Okay, so maybe just to take us through an example of where Malaysian entity, a Malaysian tax resident, receive income, a foreign source income from a country which has a DTA with Malaysia. In this case, we use India. So assuming the Indian company has paid interest to a Malaysian company of 100,000. So there would be a withholding tax of under the Indian tax regime and reduced to 10% under the Malaysian India DTA. Let's say it's 10%. So the foreign tax suffered here is 10,000 ringgit. That 100,000 ringgit of interest income will now be included in the calculation of the taxable income of the Malaysian company for Malaysian income tax purposes. So as you can see, the total income for the Malaysian company is 500,000. Malaysian corporate tax would have been 120,000 ringgit. Then, using the formulas that is prescribed by the Inland Revenue, where the DTA is available, the bilateral credit will be calculated at the lower of these formulas. So it's either 24,000, which is basically 24% on the 100,000, or 10,000, which is the actual foreign tax charge, which is a withholding tax. So in this case, you get a credit of 10,000 ringgit. So in total here, the Malaysian company would now pay a tax of 120,000. You can minus the Malaysian tax credit of 10,000, but you would have paid the tax in India of 10,000. So total tax that is suffered on this income for this company is now 120,000. If we go to Rina, the next page. Go to another example where we look talking about a situation where Malaysian company is receiving income from a country that has no DTA with Malaysia. In this case, we use US as an example. So in US, the interest income received from the US entity will be subject to US withholding tax of 30%. So you will have a 30,000 ringgit withholding tax. In this case, everything else from a Malaysian tax perspective remains the same. The Malaysian corporate tax is still 120,000. But the credit here, the difference is you only get 50%. There's the second part of the formula, you get a 50% of the foreign tax charge. So even though the US withholding tax was 30,000, you will only get a credit of 50% of that, which is 15,000. So in the end, in this case, you would end up paying more tax effectively than you would have had there been a DTA with the payer country. Okay, next page, please. So I think, like Joanne also mentioned earlier, really we are quite in early days in terms of this particular development in Malaysia. I think we consider the concession from the MOF, the 30th December announcement, to allow partial exemption still on dividend income for companies and also all income for individuals. I think, no, because we were part of the process of being part of the consultation with the government, we do understand that it was under quite, I think, a long and protracted negotiation and discussion with the authority. So we were hoping for a more broad exemption to be granted for companies especially, and we were hoping for the foreign source income exemption, the removal to only apply to passive source income. But it looks like the scope is a bit smaller than what we expected. So there's a lot for companies to consider. First is really to wait for the eligibility for the exemption, look at the conditions that will be introduced. The authorities have not actually indicated at all which way they may be going. I think in the discussions with the authorities, we have shared examples like Singapore. They have asked about Indonesia. They have also asked about Hong Kong. So, we think the MOF and the IRB is really still considering which ones of these regimes can they really try to take an example of and try and adopt some of these rules. And for companies really knowing that regardless, interest and royalty income and non-dividend income will be impacted. It's good to start looking at really what is the impact on the effective tax rate of the company, and really then look at what are the alternatives that is available, whether or not there could be any possibility of mitigation or restructuring, and whether or not then what would be the cost associated with the restructuring. The other thing is also in terms of foreign tax credits, and I think maybe this may be more relevant to situations where companies have, let's say, branches outside Malaysia. When you remit branch profits into Malaysia, the branch profits will be taxable in Malaysia now, and you will need to substantiate the taxes paid in the foreign jurisdiction. So if these are, if you have a situation where the branches have been keeping the profits in those foreign jurisdictions, and now you need to remit back, depending on how the rules work, you may need to provide documents as to the taxes paid in those foreign jurisdictions where the branches are located. So really, companies need to start looking at how to keep proper documentation to support future claims of foreign tax credits. Next slide, please. Okay, that's it for the FSIE, and this is really just to share other key updates from budget 2022. I think we only pick a few here. The first one is what we call Cukai Makmur, which translates to prosperity tax. Essentially, this is a one-off tax. It's meant to target large organizations which has chargeable income in excess of 100 million ringgit in 2022. The excess of the income that is above 100 million will be taxed at 33%. The second change was to, in recognition of the economic recovery process arising from the pandemic, the government has introduced, has announced the extension of the time limit to carry forward unutilized business losses to 10 consecutive years. Previously, it was 7 years. The third one, which is quite interesting for various taxpayers, would be indirect tax. For indirect tax, it's a special voluntary disclosure program. It allows taxpayers to make voluntary disclosures to customs for various types of indirect taxes, including sales tax, service tax, the abolished GST, departure levy, customs duties, and also tourism tax. So the most, I think what is really attractive here is apart from remission of penalty, this particular program also allows a potential remission of the tax itself, the underpaid tax itself. It will be in 2 phases. Phase 1 is for 6 months up to 30th June 2022. The remission of penalties and the taxes itself, as stated there, up to 100% and up to 30%. For phase 2 is a 3-month period up to 30th September 2022, up to 50%, up to 15% of the tax that can be remitted. The fourth one that we just wanted to highlight is this withholding tax of 2% on payments to resident agents, dealers, and distributors who receive more than 100,000 income from the same company. I think this is interesting because Malaysia, generally, we do not impose withholding tax on payments to residents. only to non-residents. So I think this is the first of its kind where we talk about withholding tax on payments to residents. But just to share this particular initiative, the Inland Revenue has just announced a deferral. What it means is payments that is made between January to March. The withholding tax on those payments can be made only in April. Otherwise, from April onwards, the withholding tax of 2% needs to be paid within 30 days of payments to these respective agents. So these are, I think, the key highlights from Budget 2022 that may be interesting. Rina, do we have next slide? Okay, yeah, so I think that's it for the sharing today. Any questions? Maybe we can look at that.
Yeah, so hi, thank you, Sharon, and Amarjit for the very insightful presentation. I was taking notes and listening interestedly, as I'm sure with a lot of the participants. So quite a number of questions have actually come in. So I'm going to start taking them in the order in which they have come in. The first one I think is, sorry, just please bear with me for one short second. Okay, the first question is for Amarjit, is just a more generic question, or why was there such a rush, right, with the withdrawal of the foreign source income exemption regime, given that Malaysia had time until December 2022 to come up with a solution to get itself removed, right, from the EU grey listing. As we know, Hong Kong is building substance requirements. So why did Malaysia, have such a knee-jerk reaction to this? Is there any particular concern that you see from the Malaysian tax authorities as to why they abolished the foreign source income regime so quickly?
Thank you, Joanne. I think two-pronged, right? One, Malaysia being a trading nation doesn't want to be on any gray list or blacklist. And that has always been the trend, and usually what I've seen, in fact, I think some years ago, there was the Labuan that was put on a blacklist, and very quickly, the government worked to get us out of the list. So similar, I can only assume the similar motive here. And second, I think is also, as you see, that there is pressure for us to be in a better fiscal position. And as mentioned in the speech, this was also seen as a revenue tax revenue generating measure. So the faster we do, the higher the chances of getting the tax revenue in, right? I think these were the two objectives. Having this removal to be done in such fashion. Okay. Although I think subsequent engagement with the ministry, I think there were efforts put in place to explain. And I think, and I see some of the questions that are coming. There are three things that everyone needs to, I guess, take note on. Now, number one, the tax is on income. It's not on capital. And that's because Malaysia just doesn't have capital gains taxes, with the exception of real property gains tax. So the first point to note is, if there's any tax, whether it's domestic or foreign, and now because foreign income the exemption is removed, it is still income, it's not capital. That's one. Number two, it relates to income that is remitted into Malaysia. So if you have foreign source income and it doesn't get remitted, Malaysia is not going to be in a position to tax it. And that was the point that I think we, as tax practitioners, and not just us, many others, brought to the attention to the Ministry of Finance, that what's likely going to happen is, in many of these cases, especially when it comes to dividend income, corporates will then tend not to remit the money back to Malaysia, and instead, simply hold the money outside of Malaysia and then reinvest outside of Malaysia. And that may not be in the best interest of the country. Okay. Yeah. Back to you, Joanne.
Thank you, Amajit. Interesting perspective there. So you sort of partially addressed the question on remittance, but then there was a question that came in, and although you have addressed it, Amajit, I'm also going to ask Sharon to maybe address this to see if she has maybe more perspective. So the question was, what does receive in Malaysia mean? For example, if it's not repatriated from a bank account outside of Malaysia, would this count? I'm assuming if they're saying that they have money in a bank account, let's say in Hong Kong, they don't repatriate it back to Malaysia, how is that, does that fall within or not the receive in Malaysia criteria?
Yeah, I think that's a very valid question, and to highlight, really the law, the legislation that's been introduced doesn't actually mention that, and there is no guidance from the Inland Revenue so far on what is received in Malaysia. I mentioned earlier there was a special income remittance program, the guidelines that has been withdrawn, the FAQ that has been withdrawn. In that, we saw a statement that is quite, I would say, fairly vague. It says it should be physically received in Malaysia or through some banking system. So it could be interpreted that the Inland Revenue is really looking, at least at this stage, at receiving it in Malaysia physically, either in a bank account in Malaysia or somehow really physically received in Malaysia. Having said that, we are aware of other countries like I think maybe in Singapore, there are deemed receipt rules. And we have not gone there. I would say in terms of consultations with the authority, we have not really brought this up because really during the earlier consultations, we did not want to bring in more and more different, more complex rules, right? As to how this will be determined. The focus was really to get the exemptions secured for as many types of income and as many types of taxpayers as possible. So this has really not been addressed, and we have not heard of any intention, at least for now, to introduce deemed received in Malaysia. What needs to be looked out for is really if the Inland Revenue issue any further guidelines, especially on the exemptions. We expect maybe there could be some further clarity in those guidance.
Understood, Sharon. So clearly, I mean, this question demonstrates the fluidity and the fact that, things are still fairly unclear and subject to change and, confirmation with the Malaysian tax authorities. But what we're seeing is for now, it seems that it does not mean a physical remittance. So if there's no physical remittance, it should not be covered. But who knows, they might go down the Singapore route of using an accrual system. So even if you keep the money overseas, as long as it's received in a bank account in Hong Kong and it's accrued to Malaysia, then it still qualifies. So let's watch that space. But thank you for that insightful comment. I'm now going to move on to, because we do have a number of questions all trickling in, and the main concern is about the Malaysian tax residency. So if I may I'll just throw one question out because many of the others are sort of along the same theme, but I'll also make sure that I address the questions that do pop up. So the one that came up here was the details mentioned Malaysian tax resident. Therefore, for me, staying or working overseas, I am not a Malaysian tax resident. So the FSI apply to me. So could maybe Sharon, would you like to take this one as well, or Amajit?
Yeah, I can take this one. So to clarify, the law that I think I mentioned earlier, that para 28, which actually grants the specific exemption on foreign source income, that is still available and still intact in respect of non-residents. So if you're not a Malaysian tax resident, there is a blanket exemption on all non-Malaysian source income. If you are a non-Malaysian tax resident, you would only be subject to tax in Malaysia on Malaysian source income.
Got it. Understood. So I know this is a difficult question because obviously the next question, and this is me asking as well, is what how would you qualify as a Malaysian tax resident? In terms of, is it the number of days that you spend in Malaysia? Is it, the fact that you have a domicile there, maybe that you have a place of residence, that, maybe you have an apartment, your family there, or a bank account? Is it possible to get some context on what would qualify as a Malaysian tax resident? Sharon, I don't know whether it's too complex a question to address in a webcast, but your thoughts would be interesting. Yeah.
It's not. So it depends on the type of taxpayer. Different types of taxpayer, different rules. Generally for individuals, I think it's the number of days, if I'm not and of course it depends on the DTA as well, or where you are, in terms of, if you are a person that is working in Hong Kong, you're residing in Hong Kong, but you spend time in Malaysia, then it's really depending on DTA between Hong Kong and Malaysia, the time spent, how do you do that, the deal breaker decision on which country are you tax resident in. But generally, I think the rule is 183 days.
Understood. Okay, so obviously that that's whether or not you are a tax resident for Malaysian tax purposes, it's not easy to answer, but the guidelines are you can use a day 183 as at least a generic test, but please seek advice on that clearly from our colleagues here if you really need a definitive opinion on that. I also want to move on to, obviously, given this new FSIE regime and so on, clearly there's going to be an increasing tax audit on investigation climate. Obviously, the IRB are out to, as you had both mentioned, looking obviously for money and company, tax being one of the revenue earners. So there will clearly be an increasing tax audit investigation climate. I mean, for Amarjit, can I address this to you? How do taxpayers prepare ahead for this?
Sure. Thanks, Joanne. So I think the tax audit increase is general. It's not going to be specific to the FSIE removal. And I think what we see is years ago the focus of a lot of corporates and individuals was about tax planning. I think we need to shift that focus to tax compliance and tax certainty, which means I think, and I break that into two parts, right? One, within the organization or within the individuals, in terms of having a systematic method or approach to document the positions that we take, document the various transactions appropriately, so that in an audit, you are in a position to bring this out and share it with the auditors, whether you're an individual or whether you are a company or a corporate. I think that so documentation will be important. Having a proper systematic approach to handling tax audit, I think it is becoming increasingly important. Right now, that's sort of the in-house bit. The other bit is, I think, in the past, especially when I first started my career, I think we used to shy away and walk away from the taxman. Lesser interaction, the better. The lesser I see the Inland Revenue Board officers, the better it is for me. I think it's quite the opposite now. I think, more interactions to ensure that we get clarity, we get certainty, to me personally is the way forward. And it's not just with the Inland Revenue Board. I think, if you're a company in Malaysia enjoying some form of incentive, again, in the past, you get your incentive, you take the piece of paper and you put it in a drawer and forget about it. I don't think moving forward, we should operate in that way. I think regular interactions, again, with the promotion agency, at least once a year, going through and making sure, that we are all on the same page is important. So message, I think, is more focus on ensuring tax compliance, more focus in ensuring that we have certainty in the tax positions that we adopt.
Thanks, Amarjit. Yeah, I think that was an interesting question raised by one of our audience attendees. So I have two last questions, and one is specific to money market funds, but I want to address the remittance one first because again, it is something that we had discussed earlier on, but maybe we can just answer this one if that's okay. It's just I'm sorry, my internet connection is unstable. I'm just going to stop. If I remit money from Hong Kong to Malaysia, any tax on the money I remitted to Malaysia? So from a Hong Kong perspective, obviously no. If it's but just from a Malaysian perspective, it's a very broad question. Any tax on money that I remit to Malaysia. I'm going to just open this to Sharon or Amajit. Obviously, it's a very broad question. You can answer that and maybe refine that to tax rate. Would they be? It's from the last question on the Q&A box. Is it too general to answer?
I think I can just start off. I think, like Amajit mentioned, right, you need to look at the characterization of that fund. Need to be able to explain to the authority what this amount is. So I think from what we've heard earlier, the example that's given to the authority was if this person was employed outside Malaysia. This was before the 30th December announcement. We were just giving an example to the authority. This person worked outside Malaysia, had employment income that was taxed outside Malaysia previously. And now, say upon retirement, that person comes back to Malaysia and remits the money back into Malaysia. At that time, I think the initial response from the authority was, well, that's remittance of employment income. So there could be a situation where the authority may have a different view, whereas we did explain, actually it's not, right? It's funds that belongs to the individuals and they may have reinvested and becomes funds that is growing from its investment, from savings. And we would say this is actually not income, not employment income, for example. So I think the authority may not really have worked out what the characterization is. And I think it's back to documentation. If you are unable to show documentation what this income is, the risk is they might want to say this is some form of income then that is taxable. Bearing in mind that the earlier exemption that we mentioned is only for 5 years. We don't know what will happen in 5 years' time. If they lift the entire exemption on individuals, we come back to the same question again.
Absolutely, yeah.
Joanne, if I may just add
Amajit.
on to Sharon, right?
Yes,
I think the way we should approach this is, firstly, what gets in, right? What's get in? Malaysian resident, tax resident. So it's not about being a Malaysian citizen, it's about being a Malaysian tax resident. Number two, the tax is on income and not capital. Number three, it is about income that is remitted into Malaysia. Okay. Then when we look at the continuing or the concession now given for the exemption to continue for companies and limited liability partnership, dividend continues to be exempted. Now, a lot of these funds, I don't know the background to the question. Some of them can come actually in the form of a trust fund. Okay. So trust funds, because it's a trust, that concession that is now given to companies and limited liability partnership on dividend income will not apply. Okay. Of course, individuals who are tax residents in Malaysia, foreign source is exempt on all foreign source income, regardless, right? Whether it's dividend, whether it's, whatever, it's all exempted. So I think I just wanted to press on this. Now, this discussion on FSIE is not yet over. We are waiting for guidelines to be issued, especially by the Inland Revenue Board. we know that there are still conversations taking place with the Ministry of Finance, maybe not so much through the accounting bodies or the tax institution, now with the other, because now this is about money market. This is right. So it's another work stream that is, is having ongoing discussions as well. And it's about, it's about having everything in balance. Now, we can't be looking at, wanting to increase tax revenue, and that then can have potentially a negative impact on, say, money market in Malaysia. So all I will say is this not yet the end. So today we've got at least an announcement out there that dividend income will continue to be exempted for companies and limited liability partnership, individuals, all income. But watch out for further developments. Joanne?
Okay. Yeah, so thank you very much. I think we, oh, yes, thank you, Amajit. So, and Sharon. So there was, my internet connection is actually unstable. There was a question on the money market funds. I think Amajit, you already addressed that just now, right? Because it depends on, whether that is, for example, as you mentioned, trust funds, or whether it relates to individuals, or so on and so forth. So I believe that's the end of all the questions that we have had. And actually we're in good time. We have 5 minutes more. And I don't know if there's any audience or participants who want to raise a question live, or want to submit any further questions in the chat box or the Q&A session. If not, I'll maybe just give everyone a couple of more minutes.
Joanne, I
Yes.
just saw, one more question, and I'll just, if it's okay, I'll just read it out. And I think it's, and maybe we'll just repeat the, so it's, okay, so let me just read it out. So it says, if I remit money from Hong Kong to Malaysia, any tax on the money I remitted to Malaysia? I think the answer again goes back to what I've just articulated earlier, right? So number one is the money that you remit is received by a resident, a tax resident person. That's the first question you need to ask. So if it's received by a tax resident person, is it income or is it capital? If it's income, then yes, it's subject to tax. Number two, it clearly mentioned remitted, so of course that tax is done. Then is it received by an individual, or is it received by a company or a limited liability partnership, or something else? So if it's individual, then it's still exempt. But if it's companies or limited liability partnership, then only dividend income is exempted. Any other form of income today will not be exempted, and you will be subject to the prevailing tax rate.
Okay, thank you, Amajit. I think that's very helpful. So I don't think any further questions can come in. So I think we might end this session. But before we end, I'd just like to obviously send a huge thank you to my EY Malaysian colleagues, Amajit Singh and Sharon Young, sitting in Malaysia. I'm obviously based in Hong Kong, but I'm in the UK right now. Also, a huge thanks to Malaysian Chamber of Commerce, to the Trade and Services Committee as well, for giving us an opportunity to present the foreign source income exemption regime. And I hope that we have, to some extent, provided insightful comments. I mean, clearly this is an area that is, again, fluid and subject to change. As you can see, based on Amajit and Sharon's update, things are being clarified, consultations are being done as we speak. So please, we will keep you updated. And, obviously, if you need to contact EY Malaysia, either Amajit or Sharon, we'll provide details to you with their emails and contacts. So with that, thank you very much. And we'll close the session today. Thank you all. Bye.
Thank you.
Thank you.
Thank you. Bye.
Bye.